Hello, everybody, and welcome to the Investing with IBD podcast sponsored by Vantage Point. I'm Justin Nielsen, your host. It is February 9th, 2022. It's a Wednesday. And joining me, as always, is Arusha Pires. He's a portfolio manager at O'Neill Global Advisors. Thank you for being here again, Arusha, as you do every week.
Yeah, it's great to be here, Justin.
And also, as our special guest this week, we have Mark Newton. He's a CMT and a managing director and global head of technical strategy at Fundstrat Global Advisors. So welcome to the show, Mark.
Thank you, Justin.
It's going to be great to have you. Of course, we're going to talk about the market in the first segment. We're going to get Mark's take. We'll talk a little bit about the IBD method and the follow-through day that we had before and where we're at now, but also get Mark's take some of the equal weighted measures that he looks at. And also in the second segment, we're going to talk a lot about risk management and how you cut through the noise and focus on what's really important. And then, of course, in our third segment, we'll be talking about some stocks, especially getting into Mark's head a little bit and see what's on his radar. So let's get right to it and talk about the NASDAQ composite. A really strong day today, up over 2%. And, we had that follow-through day on January 31st, and now we're seeing what we call subsequent follow-through days. That's where you get the price threshold. You're meeting that price threshold of a follow-through day. You're getting the volume that's heavier than the day before. Now, yesterday we got a subsequent follow-through day, but it was lower than the follow-through day. So that's a little weird. But now today, it's kind of like we're breaking above that little kind of consolidation that we had for a few days. So, Mark, what's your take? Are we out of the woods at this point, or is there still reason to be cautious?
Well, thank you. I think, it's important to differentiate between the short term and the intermediate term.
Yeah.
In the short term, I do agree that, we are seeing a little bit of a broadening out in the rally, very constructive price action out of groups like discretionary today, industrials, materials, and even healthcare. That's a good sign. I mean, these are obviously very big sectors within the S&P, and it means a lot when they move up. Look, there were some reasons why markets bottomed when they did in late January, and we can discuss that if you like. Bearish sentiment, obviously momentum and breadth got very contracted at the time. A lot of the cycles started to bottom out in January. And so I think we're in a little bit of a follow-through process now and bottoming and turning up. I think it's going to be a choppy ride. I'm not certain that we're going to get back to new highs right away. I'm constructive really between now and the middle part of February in the short term, and really between now and mid-March before I see the market likely stalling out and turning lower in between March and specifically the month of July.
So, Mark, let's get into some of those indicators that you were looking at when that we're giving a little bit of an indication that the market could be bottoming here. What were some of the sentiment indicators that you saw?
Well, I take a look at things like equity put to call, for example. That's an important thing. We did see a pretty violent spike in that towards during that final week in January. Traditional sentiment polls, I look at things like AII or DSI, things of that sort. I always find important. Bull bear index. I'd love to see signs of the trend being over 2 to see a real washout and capitulation. And I don't know that we ever did see that. But, I look at a combination of things. And so sentiment is simply one piece of the puzzle.
Okay, right.
Things have been bearish for a while, but we did start to see some increased levels of bearishness during that time frame. So that was simply one thing. Another, I look at the mark indicators. I think that was also important. And I mentioned some of the cycles that I look at bottomed out during that time. And, the combination of those made it seem like we were at a decent risk reward to potentially put in a bottom and start to bounce.
And were you seeing that both in the NASDAQ and the S&P? So for instance, like the DeMark indicators, were you seeing like the 13th count start hitting on both the S&P and the NASDAQ?
It's really just a short-term basis that the indicators appeared. So a lot of the weekly and the monthly basis, we didn't get anywhere near those appearing because it's obviously not a long-term low. It's just more of a trading low. So I look at things on really a number of different time frames, be it hourly, 2-hour, 4-hour, and when those start to line up, along with things like daily TD buy setups, oftentimes those can be important and at least triggering, a short-term low. And so that's also another important part of the process, and utilizing that along with sentiment and just wave structure also, and really measuring the degree of which the pullback was equivalent to really the first move down that we saw, and so that, in my view, was very important in thinking that this might be either a three-wave move from January the 3rd when we peaked out, and that gives the market a chance to bottom out near a time when that should happen in price and time.
Mm-hmm. Now, just kind of talking a little bit more about that idea of capitulation that you were talking about. Of course, you're looking at all of this bearish sentiment, and as a contrarian indicator, it's you kind of want to see more bearishness. That the blood is in the streets, as they say. But specifically, January 24th. I mean, the reversal on that day was pretty severe. I mean, the Nasdaq was down almost 5% at its lows on that day after really kind of a pretty steady pummeling. What more were you looking for in terms of capitulation? Just more of a decrease, more stocks getting hit, or what exactly were you looking for?
Normally in my work, I love to see fewer stocks hitting new low territory. I think that's also very important to see. One day reversal can be important. The range of that day was extraordinary.
Yeah, right.
And so, seeing like the so-called candlestick hammer pattern develop after, probably 8 out of the last 9 trading days being down, yes, that is important. But as with everything, I mean, the degree of the decline had been so severe in such a short period of time that oftentimes the first move off the lows, you almost always expect that, we could see a retest, and it wouldn't lead immediately that much higher before we see. And so that's all important, looking at, what happens during that retest, and are there fewer stocks making new lows? What's the volume like? It's all, a large process. There's not any one thing, that's important to happen. But when you look at sentiment, when you look at breadth, when you look at, momentum, and really what's participating in that move off the lows, and technology, to its credit, honestly, it sort of held where it needed to in late January. And so I look at things like the equal weighted technology ETF, which is by Invesco. And so I look at ratios of that versus the equal weighted S&P. So a combination of those, often, at that time we had gotten down to really make or break levels. And so that was key in my thinking that, okay, markets could be putting in at least a near-term low.
Well, let's maybe pull up that chart real quick and just kind of walk us through your thinking here. So what is it that you're getting out of the equal weighting? And maybe just walk us through this chart and what it is that you're looking for, what it's showing you right now.
Sure. I mean, I think that, for the first time in almost 50 years, we see about 25% of, all the indices being made up of 5 stocks. And I think it's really an extraordinary time. And people say, well, that means the market's, due to crash. And I say, well, no, it's not necessarily a new normal. That if you study history, in 1930, AT&T was the number one holding, along with the Generals, General Motors, General Electric, and they stayed that way for almost 60 years. Wow. And so it's really an old normal, not a new normal. And the fact that, yes, we all have to account now for the fact that you have a small number of stocks that are making up a big percentage of the S&P and the Nasdaq and many of the different ETFs. And so, many times over the last year, many of us have looked at the market when, the market's down, but yet, many of the sectors were up. And so a lot of that is just the influence of these key technology stocks. So bottom line is this index started to turn back higher, this ratio, right around the time of the previous U.S. election in November of 2016, and it's been going up ever since. And it's been choppy in the last year, but as you see, it really bottomed out in May of last year, and that's when technology really started to move up aggressively. But that red uptrend line has not been violated, and that still shows that technology is an overweight. And so when I see evidence of that start to give way in a bigger fashion, then it really will be a time to say, okay, growth is going to have a more material drawdown, given that technology is 28% of the S&P.
Mm-hmm. And so just so people are clear, I mean, if you wanted to do this at home, you're talking about the Invesco S&P 500 equal weighting. The ticker symbol on that is RYT for the tech. And then for the S&P 500, do you use RSP, I assume?
That is correct.
Yeah. Okay. So
the Invesco equal weighted ETFs will allow you to do these ratios and study some of the movement, in the sectors.
Okay, great.
Okay, Mark, I think probably to end this segment, let's go into a little bit of your background. You've been doing this for a long time now.
Yeah.
Just walk us through how you got into this, because I think we probably both got interested in this yeah, well, at least I was getting interested in 2000s. But back then, there weren't a lot of people interested in technical analysis, and it was just kind of this on this periphery. How'd you end up getting into the technical analysis world?
Yeah, I've always loved the way that markets move, and realizing that it's not just about earnings or Fed speak that causes stocks to go up and down. And so it was always a source of fascination. But really, in the early '90s, when I got out of college, I worked at a small mutual fund called the Calvert Group, which is a socially responsible mutual fund. And one of the portfolio managers for one of the funds was Seth Moses, and he was a disciple of William O'Neill. And I really started to read a lot of the different books at that time, and how to make money in the stock market, and ingrain myself in the Can Slim methodology. And so it started from there. I started out as more of a momentum based trader, investor, looking for stocks that are breaking out to new daily, weekly, monthly highs. And then I did a stint out at the CBOE and traded equity options as a market maker in the late '90s. And so I was able to make use of technical analysis there, but really fine-tune my process and incorporated a lot more Elliott Wave, a little more GAN, a little more ways of looking at time in the work. And then sentiment, I feel, is probably the most important thing that investors need to pay attention to in finding extremes in sentiment. So it all was part of a general methodology. But I traded equity options out in Chicago for about 6 years in the late '90s. I moved to the New York City area in 2004 and started work at Morgan Stanley, and ended up running their technical department back in 2006 to 2007. And then I worked at the hedge fund for a while, Diamondback Capital Management. And then I started my own gig in 2016 as a way to provide technicals to investors and institutions. And then fortunately, I've had the fortune of just accepting a job with Tom Lee and John Bay. And so being able to work with Fundstrat, it was a dream of mine. And so it's wonderful to be able to have, a larger platform to be able to broadcast and tell what I'm seeing to the world and educate people and just use technical analysis. I think it's great.
Well, we're definitely happy to have you. And when we come back from the break, we will talk a little bit more about some of these indicators that you're looking at. When is too many when are the indicators too many to deal with? How to cut through some of that noise, and also a little bit more about the risk management side of things. So stay tuned. We'll be right back. Why trade off hope and optimism when you can trade using the world's most powerful indicator? Artificial intelligence has been used by traders to navigate the markets for the past 3 decades. Visit freestockcoaching.com to see the world-leading AI forecasting software for yourself. Trusted by more than 32,000 traders, AI uses millions of data points to track market trends, giving you the support you need right now. Go to freestockcoaching.com and we'll help you find great opportunities today. Our experts will show you what stocks are setting up for big changes right now. So head over to freestockcoaching.com for a free demo. Trading involves financial risk and is not suitable for all investors. Past results do not guarantee future performance. Okay, welcome back everyone to Investing with IBD, sponsored by Vantage Point. It's Justin Nielsen here, your host, along with my weekly guest, Arusha Pires from O'Neill Global Advisors, and our special guest this week, Mark Newton from Fundstrat Global Advisors. So, Mark, one of the things that you were, kind of alluding to is this whole idea of different time frames. You kept on referring to, maybe on the short term, you're thinking one thing, long term, are you thinking something else? Maybe discuss how you might have a little bit of a different view depending on what time frame you're looking at.
Yeah, no, Justin, I think that's an incredibly important point. I think that people, it's good to really honestly analyze not only daily charts, but weekly and monthly, and realize that although some people say that, momentum got oversold in January, that when you look at monthly momentum indicators, we're barely just creeping down from overbought levels. And so it's really not that oversold. And so, short term, there are reasons to be, take a counter trend stand and consider buying the dip. But we have done a lot of damage, and just literally within the last 6 to 8 months, I would argue. But really since November, we saw a lot of indices peak out at a time when technology was still going up and start to roll over. So that's caused, right now we have less than really 50% of all S&P issues that are above their 50-day moving averages. And, we have seen a nice little snapback in the S&P in the last few weeks, but, the broader damage is something that I think is going to be increasingly important this year. And so when you look at cycles such as, the midterm election cycle tends to be one of the weaker of the 4 years, and the fact that January was down, the combination of those likely means that this year could be a lot flatter than what people suggest. And so my own analysis during my outlook that I gave a few weeks ago on 2022 suggested that we should be in a sort of a V-shaped type pattern for this year, where the first 6 months could be challenging, and then we could start to rebound in the latter half of the year. So, weekly momentum right now is still negative. I have a problem with that, and long-term breadth issues are still very much a problem for the market. And many of the cycles that I look at turn down pretty sharply from March into June, July period. So I think Q2, specifically after the Fed meeting, that could be really a catalyst for not only interest rates starting to roll over again, but maybe stock indices starting to fall. So while I'm more short-term bullish, I think that between now and July, I'm a little bit more skeptical of the market's ability to immediately rally back to new highs and everything should be fine. And I think we have a lot of wood to chop in terms of the market being able to recover based on the damage that we've seen.
Yeah, and Mark, now one of the lessons I think we all learn when you start trading the markets and trying to really analyze them is trying to balance between overconfidence and gathering, trying to absorb too much information, or how you balance that information. How do you handle that, and what have you learned between that kind of balance of you don't want to be too overconfident on any kind of thesis, and be open-minded enough to take in the information that the market's actually telling you?
Yeah, that's a great point, because once any of us get too ingrained in our thinking of this has to happen or needs to happen, then when something goes the other way, many of us experience this cognitive dissonance where we just ignore it. We all think the market's going down.
That doesn't fit with my worldview.
It's like all of a sudden if it goes up, then we're like, well, that can't be possible. And in the media, to some extent, influences all of us, and really, positively and negatively. And so it's important to be as much of a machine, I think, as you can, and non-emotional, and saying, I'm relying on maybe several different factors, sentiment being one, seasonality, momentum, breadth, leadership, overall structure of the market, and really not try to allow anything else to come into that framework that would influence you. And so we're all guilty of, allowing the media to, I think, affect us. And when the market goes up, we say, oh, it was because of the Fed. And then when the market goes down, it's, nothing has changed. We just change our opinion as to, oh, this was important on this day, or it wasn't on this day. And it's like, well, wait a minute, it can't be both. So which is it? And if it's,
right,
so if anything, we need to really eliminate that bias and learn to really understand each of us internally, psychologically, in terms of what kind of a trader are we? How successful are we in managing our different time frames? Be it, some of us are better suited at day trading, others are more swing traders, some of us are long term, and really discover where we're comfortable in our own skin at how to approach the market.
Mm-hmm. So one other aspect of this, it sounds like you have a lot of different indicators you're looking at. I mean, you've already talked about sentiment, you've talked about all of these different things. Right. What happens when you sometimes get different signals? One of your indicators is saying, oh, this is bullish. One of your indicators is saying this is bearish. How do you make a decision based on conflicting signals sometimes? Yeah,
the bottom line is that price rules, and so that's always the thing that I am really putting above everything else. And I don't care if sentiment is, bullish. If price is moving up, then I'm going to respect that. And so until it's proven wrong. And so I guess I do weight them a little bit differently. I don't weight them equally where I throw something out. It's a great question. I think it's different, in different scenarios, and you just sort of have to, the probability, the evidence suggests you ought to take a stand. Well, I will when price proves that out and shows me. If I'm calling for a reversal, I usually won't until price gives me that confirmation.
Mm-hmm. Mhm. And you also addressed already, sometimes what you're looking at isn't kind of the day to day. It's more, hey, am I at the extremes?
Right.
Because that's where, that's where the turns can come a lot of
Look, a
times.
lot of investors, they look at daily charts and they say something's breaking out, and I say, well, that's wonderful. But if you look at a weekly or monthly chart, it might
Right.
not. It might be
Right.
part of a larger consolidation pattern, and it might not be all that bullish. So it's really, really important. And I learned this from day one, to look as far back as possible or get as much data on a stock chart that really will give me, the message. And then I'll really go more and more, short term in nature and look at weekly charts and daily. And, if I want to make a decision for the next couple days, and I'll look at more hourly charts and look at Elliott wave structure and have that be a guide for how I'm looking at things. It's all based on the time frame at which any of us are trying to make decisions and manage money, and risk tolerance is a big part of that.
Yeah, and going into that a little bit more with the risk management, do you generally try to look for stocks or ETFs or any instrument that's closer to a danger point, like right on near the support areas, or more of a type of buy on strength near all-time highs?
Yeah, those are several different categories. Recently I put out a piece that suggested that China could be bottoming, Chinese
Wow.
technology in particular, and for a lot of reasons, but based on longer term support, based on sentiment being very extremely negative, where many don't want to touch it with a 10-foot pole
Yeah.
for
Right.
a lot of the right reasons. But look, I think that that's obviously a buy the dip on something that's been hugely washed out. But normally my toolbox is that I want to find. And we'll discuss some of those stocks today, stocks that are breaking out of, narrow bases that have been trading near or at all-time highs that are just now starting to break out. And for me, those are the lower risk type situations to be long on like a 4 to 6 week basis. Whereas something that's pulled back sharply on a short-term basis, but is within a longer term uptrend where we can try to take a stab at buying dips. And that's a different type of way to use technical analysis, as you know, to try to make an educated decision on, adding to something that you like. You just want to hope that the stock will bottom and not start to show more and more weakness that might shake you out of that position.
Mm-hmm. And so, kind of staying with this risk management theme, what kind of makes you decide, hey, I was wrong. My thesis was wrong on this. I need to cut my loss. Do you have loss cutting mechanisms? Do you have a percentage? Are you looking at different technical support levels that you're going through, or hey, something turned with my thesis, and I just can't ignore that. What is it that you look at the most?
I do find that and that's part of what makes people successful, is admitting you're wrong and changing your opinion. And it might not be that it's changed forever. It just means that, at the time it was a trade and it didn't work out and you have to revisit it. And so no matter how good the story is, so I don't use a percentage per se, though I would typically say, between 5 and 10%. But I oftentimes will use, the structure to tell me that I'm wrong. If something breaks longer term trends that I was thinking might hold, or if it breaks a prior swing low. And I think that, at my own Elliott wave knowledge will tell me that if a certain level is violated, then the whole structure is wrong, and you really want to revisit that. And I think that is really an important tool that many people should could consider within their analysis, and not just, well, it's down 5%, so I'm out. I mean, that might work, but I almost always use prior highs and lows and really try to create the most optimal risk reward picture, and not chasing breakouts necessarily, or wait till it revisits that pivot before you buy. It really depends on the circumstance. I'm not really a one sort of tool type person. It really depends on what I'm looking for.
And what about like diversification? Where do you spread it out enough that one thing can't really hurt you, or are you going to be more concentrated and let the risk management kind of take you out when those things aren't really working?
Yeah, I think that if we start to be involved in a sector that's trending strongly, and for the record, I'm not a portfolio manager, but yes, I do trade and invest my own money. So most of what I do is try to help others make money by my analysis. But I think that diversifying is obviously important when markets start to show evidence of rolling over, like what I think happened in November through January of this year. And so, when weekly MACD is trending south and markets, there's a huge number of stocks that are now down greater than 20%, below their 52-week high, and really just stick with the sectors that are showing you the most strength, which right now is energy, which is up 23%. And so, I can afford to have a little bit more concentration in sectors that are acting really well versus those that are I'm trying to buy dips that have already weakened substantially and trying to position for a bounce. And so that's also part of the the time frame management and the risk tolerance, where I'd be a little bit less apt to put large positions in something that's already weakened substantially. And base building takes time, and rallies. The more strength, the more that I'm going to have conviction. And I don't mind running money as more of a momentum driven system, where if something weakens substantially, then I get rid of it, and I don't look back. It doesn't matter. There's always going to be things that are hitting new high territory that I think are attractive. And as a final point, diversifying amongst, outside of equities into things like cryptocurrencies or treasuries or commodities. And yes, those are part of, a long-term cycle of success, where I think we all owe it to ourselves to be involved with these. But, sometimes, the patterns are so compelling that I might put a few more percent into something because I think it looks really good. And I can't think that I have this down to a fine science where I know exactly how to manage portfolios for success. I have my own, sometimes I've been successful when I've overweighted things and maybe taken a bit too much risk than I should have. But I always use stops as ways to get myself out of something that's not working.
Yeah, no, I mean, especially here with IBD and the O'Neill system, stuff like that. When things are working, when everything's lining up, we'll definitely concentrate more.
Right.
But we really are depending on that kind of risk management being stopped out to get us out when things start to turn, versus the diversifying and hoping that protects us. Because as you mentioned, Mark, everything will come down when things get really bad.
Look, let's be real. I mean, all of us have gone through a couple nasty years of COVID, and many of us are dealing with, many different personality types, our own included, that might not be all that cheery on any given day, or thinking clearly that we can get out of something. And you might find yourself certain times of the year you're trading better than others, and I believe that 100%. That sometimes it's not running well or making the right decisions, and so it's up to you to understand your own frame of mind in terms of when things are going well and why it's going well.
Yeah, I just wanted to, before we move on to the next segment and talk about some stocks, I just wanted to kind of address your philosophy on, like, maybe selling into strength, or when is the move kind of, I've gotten the heart out of the watermelon on this one. Are you waiting for those signs of extremes, maybe extended above the moving averages, or is there something else that you're looking at that kind of tells you, hey, I've hit a price target or something for a stock that makes you say, I'm going to sell this one and move on to the next one?
Yeah, that's all, I think, a question of risk tolerance and how we all manage risk. And I can kick myself because I don't own any Apple or Amazon here, and maybe I should. I sold them a long time ago, and I've revisited them, but my own time frame is probably shorter than many who might buy and hold and have a different way of managing these stocks that have gone up 20, 30, 100 times and now have started to churn a little bit sideways, and maybe those aren't right to hold through that. Other people say, I bought them so much lower that it doesn't matter, and they're great companies. And so each of us has different answers to how that they would manage that. I think as a trader, I look for a combination of a few things. One is negative divergence on several different time frames, and so that is important to me on a short-term basis as well as a weekly basis. I look at DeMark tools for getting out of certain things when things are extended as a counter trend tool to balance my own trend following tools. I think that's key. And if we're moving into a time that I think has cyclical importance for a broader market, and if something starts to act a little strange, oftentimes I depend on the price action. If price starts to not act well, and my patience runs out, then I'll get rid of it, and I can always revisit that. I don't mind, missing the top, and if it breaks out again, then I'll buy it again. And so my time frame might be shorter than others who might be listening, and so it's not fair for me to say this is the way to do it. But look, I try to use stops, and if a stock starts moving up nicely, then I'll raise stops to near structural levels that I think are important, and simply have use a trailing stop so I never get back a lot of what I've made. I always want to stay in the position if it's working. I don't want to get shaken out if it moves sideways for a little bit and then continues higher. But some of that also depends on the size of the position. And if it's too big, then I don't mind taking some off and putting it into something else that's acting well.
Mm-hmm. Yeah, all good points. And we'll get more into some of the sectors and the stocks that are on Mark's radar when we come back. So stay tuned for that.
Do you want to conquer market volatility? We can help you protect your hard-earned capital. Visit www.freestockcoaching.com and find out how Vantage Point's AI technology can forecast stock market trends up to 72 hours in advance with incredible accuracy. Vantage Point's patented technology analyzes huge quantities of global data in seconds, so you can finally stop guessing what's going to happen next. Check out www.freestockcoaching.com and experience Vantage Point for free. Learn how successful traders generate their wealth. Trading involves financial risk and is not suitable for all investors. Past results do not guarantee future performance.
Okay, welcome back to Investing with IBD podcast, sponsored by Vantage Point. It's Justin Nielsen here, along with Arusha Peiris and our guest, Mark Newton. Before we kind of get into some stocks, Mark, I just wanted to kind of ask if people are interested in kind of following some of your ideas here. You've mentioned a number of things that you've written on some of these, these trends that you're seeing. Where can people kind of follow your ideas? What's the best place for them to kind of take a look at that?
So since I joined Fundstrat back in September of 2021 last year, the majority of my analysis goes out to clients, both institutional and retail. But I still have a Twitter following. You can follow me on Twitter at Mark Newton CMT, or join FS Insight. FSI is the retail arm of Fundstrat, and so I publish daily. I put out 5-minute video.
Okay.
And, in the works is going to be quite a lot with regards to cryptocurrencies and monthly reports and my own long short list and trading ideas, and all that's going to be in the process. But I am a one-man show, so it does take time.
Yeah. Well, I'm sure there's going to be a lot of good content for people to take a look at. So speaking of which, let's go ahead and get into some stocks. One of the areas that certainly has started 2022 out with a bang really has been energy. Oil and gas seems like that's the groups that keep on popping up. A lot of the stocks, you look at them and you say, what correction? They just look like they didn't participate at all. They formed nice short little bases and were already at highs. So what's your take on energy right now? I mean, we have so many different things that are, so many variables to look at, whether it's the price of the dollar, you've got the Russia-Ukraine situation. How do you make a decision on what time frame to look at on this play?
Yeah, that's a great point. I think that I could make fundamental comments that I don't think they're ever going to be able to raise supply to the level that they need to combat demand, and demand still remains strong. The U.S. consumer's in great shape, but you look at the performance of energy last year, which obviously outperformed sharply, but after a number of years back, it literally didn't. And so my own study and using relative charts like we've spoken about, and I look at energy breaking out in relative terms when you look at equal-weighted energy. But January was a great month for energy. It's obviously huge sector dispersion, and it's up over 20% for the month. I've done studies going back since 1945, and you see that when energy is the top three in terms of leaders for the month of January, that over half the time, it's happened, I believe, 18 times since 1945, where energy is either first, second, or third best performing. 8 of those 18, energy went on to actually finish in the top 3 for the year. So that was interesting to me. And also the fact that we've had such technical strength, we just haven't seen any evidence of this really rolling over at all. And so this has just been, so I look at things like XOP, which I think are interesting. And it's important to, as we spoke about earlier, taking a very longer term look at the chart and looking at the fact that while many might suspect energy is overbought, and I don't disagree on the short term, long term, we've literally just seen a break of a long-term trend going back since 2014. And so that's really interesting when just connecting highs from, 2014 to the most recent high in 2018, and now we're clearly above that. And so this is really an interesting group for me, and this sort of mirrors our own Fundstrat's Tom Lee, who's taken a very long-term bullish view on energy for the next few years. So, I like it technically. I think the way you trade it depends on your time frame. I think that crude likely is going to get up to 114 by the middle of next summer. That's when a lot of my crude cycles move up into and then roll over. So, it's going to be likely 2 steps forward, 1 step back. And I don't disagree that it might need to consolidate. And that happens probably between March and July of this year, which is when I think the broader market also could experience some weakness. But I think that, dips are going to be used to buy, and the group remains strong. And personally, I love seeing long-term, breakouts of trend lines and just structural shifts that make things a little bit more positive. And for me, that's one of the most important things that I think investors can utilize. I mean, if they looked at stocks like Microsoft or Apple way back in the day, most of those stocks went sideways for a dozen years and then, had massive breakouts. And so these are things that, are very, very important when you see structural shifts that really make you almost ignore the short-term overbought situation, only because structurally, when you get above a prior year high going back a dozen or 20 years, it's very important. Even if the overall nature of the business has changed, I still find that it works time and time again, that you see very, very good signs of strength.
Mm-hmm. Yeah, I mean, and really going off of that kind of thought, even with the NASDAQ and the S&P, once they started to get into all-time highs, especially like the NASDAQ getting past that 5,000 level, the 5,100 level,
right.
That was very significant, even though in real time, it didn't seem like it could be the case.
100%. And so it just, to all our points, it's good to have, that kind of time frame concentration where you're looking at weekly and monthly charts as well as daily, and it can help to put some of these moves into perspective.
Yeah.
Mm-hmm. And certainly, just to kind of go back to the XOP, this is the oil and gas, the explorers and producers,
right.
And it doesn't show on this chart because XOP started in 2006, but I mean there was really a big move, 2004 to 2008. I feel like in energy, and maybe XLE shows that, but you also were talking about the equal weighted. So is that RYE that you use
that's
for
correct.
that? Yeah, okay.
I think that in general, if you're bullish on energy, XOP will give you the most bang for your buck with regards to alpha. During defensive times like we saw in January, where markets are volatile, XLE will tend to work a little bit better than XOP with the Exxon and Chevron exposure, and
very heavy, over 20% for both of those.
Those big companies that are thought as safety plays to some extent. When markets really start to weaken, many gravitate towards those. So those outperform, and obviously the OIH is more of the Schlumberger and the Halliburton, and those have played catch up in a big way lately. But for me, if I'm a long-term energy bull, I love the exploration and production area, and many stocks like Apache, for example, was literally just started to climb off the lows, and is a stock I think plays catch up. Many would gravitate to look at EOG, which has been strong, but Apache peaked out a number of years ago and is still, has not really even climbed. I think it's about 50% of what its all-time highs, and it's still in a very sharp period of acceleration. So, lots to choose from in that group.
Okay, so let's kind of shift gears into maybe the healthcare sector, because this is another area where it seems like there's some of these stocks have been consolidating for a while and are now kind of getting some new renewed energy into them.
Yeah, I agree 100%. Healthcare as a group, it is very important with regards to the S&P. It's the second largest weighted sector by percentage terms. And so healthcare, it's important to do a little subsector digging, because parts of healthcare like biotech have really fallen on hard times, and they've been going down for a year as of now, actually. They peaked out right around this time in February and have been, unfortunately, not the best place to be. But other groups like pharmaceuticals have been phenomenal, and that speaks to sort of the defensive tone, I think, of the market of the last 6 to 8 months, and really a sort of a sideways, choppy market, and particularly in January. But you look at stocks like Pfizer, for example, and breaking out of longer term bases going back since 1999, an extraordinary long-term breakout in the stock, and many people have written the stock off. I think, you speak to them about Pfizer, even though they're having such huge success this year with the vaccines, saying, well, that's a has-been, and it's not going to make me any money. But it's this is a pretty exciting move in my view, in looking at just the DRG, or looking at many different stocks, AbbVie, ABBV, or Eli Lilly, or Bristol Myers, or even Merck. And Merck is one that's lagged a little bit, Pfizer, if you look at it on a monthly basis, and hasn't really made the breakout yet. But I think that's forthcoming, that should happen. But Pfizer is a clear leader, and if anything, the short-term pullback in the last month has given many that are intermediate-term investors a good time to really buy dips, in my view. You've seen the big breakout and the acceleration which happened in December for the DRG, making new all-time highs, and now you've seen a little bit of a weakness that I think should be a buying opportunity.
Yeah, Pfizer's breaking out of essentially, I guess, a 22-year
Right.
base, which is remarkable. I mean, it's kind of like this monster cup with handle, or a saucer with handle. And going back to some of those other long-term charts that we're looking at, like the NASDAQ and stuff like that, this is pretty significant. There was some big volume from a few months ago coming into it as it got above those resistance levels. And so it's going to be really interesting to see what Pfizer does in the future.
I do own Pfizer, and this is a long-term hold for me. I love the stock on an intermediate-term basis, and this is in this case, if it were to pull back more, I would just keep buying more. It's one of those things that I put myself in the mindset of a long-term investor. When I see long-term breakouts like this, it makes me excited to be able to invest in a great company like this, and I think it's going to show better returns, hopefully in the years to come than it has.
And sometimes with these stocks, one of the challenges is, especially if you're looking at the short term, news items, of course, whether it's FDA approvals or how clinical trials are going, what have you. So when you're dealing with something, of course, a lot of the stocks that you're talking about have such a broad pipeline. One drug isn't necessarily going to make or break them, but how do you deal with that kind of volatility that can come in on the short term?
Well, that just, a lot of it depends on what basket you choose to put the stock into in terms of time frame. And for me, it's a long-term basket, so I don't really pay attention to a lot of the news, and I usually try not to, unless it it really shakes me out of stocks that really start to violate trend line. If this were to really start to break down substantially, I would have to pay attention to that. But for me, that's a short-term problem,
right?
I think, and that's for those that are short-term in nature. When you see that, deterioration, that then you avoid it, you get rid of it. But for me, I'm buying it for different reasons. This is a long-term buy for me. So, and
it kind of again speaks to how you can treat some things in that short-term basket and other things in the long-term basket, and the rules are kind of very different.
100%. That's correct.
So maybe we can also take a look. Industrials were certainly one of the areas of strength today, and I know that you mentioned when we were kind of talking in our pre-show, Deere was one of those that was on your radar. This is something that we put on Swing Trader. Again, kind of looking at this as a short-term play, but what's your take on this? It's really kind of a longer base since March of last year, so almost a year long. Is this more of a short-term or long-term move, do you think, here?
For me, it is likely a 4 to 6 week move. But in general, I love finding stocks that have multi-year run-ups and then go sideways for a number of years, like Deere has, really, since in the last couple of years. It's really done nothing, and all of a sudden now you have a shallow base. It's within really the top quartile of a stock's overall range, and it moves sideways, and then you see that breakout, and it happens on very good volume. And so a few days ago, I noticed that the stock has made an above average gain on good volume, and clued me in that maybe this is the time that it breaks out, and it just happened to be, we're sort of lucky that it literally just happened. And so the stock has broken out, and it looks very, very good to me. So it's something where I like to be long still and buy dips, but the longer term structure is great in it. So I don't know why anybody would avoid it, but that's all risk tolerance and time frame.
Yeah, and I have to say, I was so surprised at the 2020 move.
Yeah.
It just did not look like Deere
Right.
anymore. That phenomenal move that it had.
Yeah. Yeah. Yeah.
Yeah,
100.
and if you look at it like on that monthly chart with using the 2020 run, you almost have like almost maybe a little bit too long to be call it a flag, but it's a strong move up, consolidating for a year, and starts to emerge out of that. It could continue kind of that previous strong move up.
Yeah, my own study of how some of these machinery stocks move. A lot of these are tied into the move in the U.S. dollar also, and when you see the dollar decline substantially, I mean, companies like Deere and Caterpillar that have a large percentage of their revenues come overseas, and I'm by no stretch a fundamental analyst. I got to level 2 of the CFA, and I found out what I was doing wrong. I was highlighting with a black magic marker, and so I had to give that up for 10 more months, and move on. And so, look, my own view is that the dollar is going to roll over this spring and should start to move lower. And so, if that happens, we'll see. But that would be sort of a tailwind for some of the industrial group that's really lagged so badly, and for stocks like Deere, that should be a positive.
Well, and maybe that kind of leads us into maybe a final point of kind of taking a look at the bond market. You were talking about some of your projections on rates. Of course, a lot of eyes are on the Fed. How many rate hikes are we going to get, and what kind of pressure that's been putting on the 10-year Treasury yield lately? So, what's your overall take on the bond market?
Short term, I'm negative on treasuries. I think yields likely creep up to 2.1 to 2.3% between now and the middle part of March. And then, I think there's two reasons why I think yields peak. Technically, one is based on just longer term trend lines from going back 30 years that show that to be a pretty meaningful area of resistance for TNX. And also a lot of my cycles, I have a composite that I look at that shows treasury yields starting to roll over pretty sharply between March and September of this year. So I think that, which means, unfortunately, that the Fed might make the wrong move and potentially hike either more aggressively. That's not my area of expertise, but I think something could happen which could affect growth in the economy and economic weakness, where either a stock market decline or evidence of the economy weakening substantially, where we'd start to see yields really roll over. But short term, I think the move in both TYX, TNX, I think it's going to go higher. Yields go higher. From a price perspective, treasuries go lower. And so how you play that depends on your time frame. But I think over the next 4 weeks, I think being long TBT or different gauges of how you play treasuries through ETFs likely is going to work. And then I think it's going to be right to reverse that and be long treasuries into what I feel is going to be a volatile time for risk assets, specifically between April and July.
And just kind of a final point on that, because you were mentioning some of the cyclical studies that you've done.
Yeah.
I guess one of the things that a lot of people are kind of bringing up is this time different. We have quantitative easing, which we just don't have a lot of precedent for how much money was injected into the economy here. So does that kind of factor in, like, can I use this historical precedent in this case, or is it kind of like, hey, these things just repeat? It's different catalysts.
Everybody always says it's different this time, and any of us that have used technical analysis for any period of time will always tell you, it's never different. I mean, But charts matter. Price patterns are certainly important, and so it's anybody's guess as to how many hikes the Fed is going to do this year, or whether that's going to be, doing too much or too little. It's clear from what all of us are hearing in the media every day that the Fed seems to be behind the curve, and there's no easy path out of this. And so, I think that we're still in a low environment for yields, and we'll see if there's going to be any sort of meaningful downward pressure in the stock market this year, which would coincide with a lot of what we've been talking about, midterm cycles and a poor January. Then it's tough for me to see yields. It's tough for me to see both stocks and treasuries correlating perfectly, where both are going to go down. Meaning yields go up as stocks go down substantially. I think there will be some flight to safety, and we'll see people adding duration and getting back into treasuries into the spring.
Mm-hmm. Well, Mark, really appreciate you coming on the show, sharing your thoughts. A lot to kind of digest from this one. And again, as a reminder for people, you can always follow Mark on Twitter at MarkNewtonCMT. And on the show next week, we're going to have John Kosar returning to the show from Asbury Research. He's another CMT, and he's got a correction protection model that he's shared with us before. So he'll give us an update on that and where he sees the money flowing into the different sectors. So stay tuned for that. Thanks for joining us this week. We'll see you next time.
Make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.